Good evening, everyone. My name is David Sung. I'm president of Nicola Wealth Management. And on behalf of all of us here from Nicola Wealth, I'd like to welcome all of you, both clients and the many guests I see here this evening, to our presentation. Now, we're here tonight to talk about one thing, and that's real estate. So let's jump right in. Now, I get the sense in looking at the audience tonight that you might be somewhat real estate favorable. So I'm sure it'll come as no surprise to many of you that throughout history, some of the world's most successful and well-known families have built a significant portion of their wealth through owning and investing in real estate. Now, about 5 years ago, one of our partners, Wayman Crosby, and I, we co-authored a newsletter titled Invest Like a Kennedy: How to Build a Personal Real Estate Empire. Now, when most of us hear the name the Kennedys, we think of America's royal family. They are probably one of the most well-known U.S. political families. They are descendants of wealth and high esteem. But how did they build that wealth? Well, it all started with Joe Kennedy, who in the 1930s and 40s, through business-building enterprises, built a good portion of their family wealth. And these enterprises consisted of such things as banking, liquor importation, and with their brokerage firm, insider trading, which actually happened to be legal at the time. But while the brokerage firm and the liquor importation and the financing of Hollywood films were all the headline-making activities, what many do not know is that the vast majority of the Kennedy family wealth came about by investing in real estate. And the centerpiece of the family's real estate financial fortune came about through a deal that Joe Kennedy struck in 1945 to purchase the Merchandise Mart in Chicago. And he bought that for just under $13 million. And this proved to be the foundation of the family financial fortune for generations to come. Now, when he purchased the Merchandise Mart, at the time, it was the world's largest commercial structure with just a little over 4 million square feet in total. And the Kennedy family, they did eventually sell the Merchandise Mart in, I think, about 1998 for just about $600 million. So the Kennedy family, I think we all know, they got a lot of things wrong in their lives, but one thing that they did get right was investing in real estate. I've got a little funny here because when you think about the family notoriety, this is the type of multifamily residential commercial real estate asset that you might picture the Kennedy family owning. Now, with that backdrop on wealth building through real estate, and for those of you here who are clients, you'll be familiar with this slide, which we've shared with you many, many times. This shows the asset allocation of the average Canadian balanced mutual fund. It's often referred to as the classic 60-40 investment portfolio because 60% is invested in public stocks, 40% is invested in public fixed income. But maybe to provide a little bit more context, here are some, and compared to the last slide, here are some actual specific examples of some well-known brands. And you can see what they have in common is roughly a 60% allocation to stocks, 40% to bonds. But what is clear, and I'm sure you know where I'm going with this, is a noticeable absence of any exposure to commercial real estate. So was this a good decision? How did this work out in terms of investment outcomes? Over the past 10 years, the average annualized compounded rate of return of the average balanced mutual fund in Canada has been 3.98%. Now that's the good news. The good news, of course, is that that is after fees. The bad news is it's still 3.98%, and that's before taxes, any taxes owing, and inflation. It's our view that having exposure to high-quality, commercial-grade, physical ownership of high-quality commercial-grade real estate in any high-net-worth investment portfolio is prudent. However, it's not just our view. What you're looking at here are two of Canada's largest public pension plans, the Ontario Teachers' Pension Plan and the Canada Pension Plan. And you can see they have a far more diversified asset allocation. Their annualized 10-year rates of return are anywhere from 2 to 4% higher. Now, 2 to 4 doesn't sound like a big number, but put another way, that's anywhere from a 50 to a 100% greater annual rate of return. All of us know that small changes in compounding over any extended period of time can have a significant impact on future values. Now, our core model asset allocation is very similar to these pensions. Now, while our individual client results will vary based on customization, it's our view that long-term investment results are driven not by necessarily the individual security selection, but more by the asset allocation decision. Now, whether it's these large pension plans or large foundations such as Harvard and Yale or other sovereign wealth funds around the world, most of these institutional investors all have a more diversified asset allocation. Of course, they still invest in the public stock and bond market, but not to the same degree. Instead of having a 60 or 70% exposure to public stocks, on average, most institutional pensions have anywhere from a 30 or 40% allocation. And in place of that, where they've chosen to allocate are two other areas: investments in private businesses through private equity, private debt, mortgages, farmland, infrastructure assets such as tolls, bridges, roads, and dams, and of course, real estate. Now, whether it's the Canada Pension Plan, owning and investing in some of the AAA office towers in most of the major urban centers across Canada and around the world, or Ontario Teachers, as an example, owning Pacific Centre Shopping Mall, the largest shopping centre in my home city in downtown Vancouver. All of these institutional pensions feel that having exposure to real estate as part of their long-term strategy makes sense from a long-term wealth building perspective. Now, over the past 25 years, piece by piece, we've built an investment platform that can both support and invest across these broad asset allocations. And I know I could probably spend at least an hour talking about each component of the pie, but I promise that we're here to talk about one thing tonight, and that's real estate. Our first presenter this evening is my business partner and our CEO, John Nicola. Following John is the managing director of our real estate group, Mark Hanna, and Mark will be moderating a panel of three very seasoned and experienced real estate professionals. So with that, I'm going to turn it over to John. John will begin with our macro overview of where we feel we are right now in real estate, and then he'll shift towards where we think some of the opportunities might be going forward. Enjoy the presentation.